Do you know that there are literally tens of thousands of stocks that are traded across the world? I would say even more, hundreds of thousands of stocks. The question is how to actually find them, because you simply cannot flip the coin and think that this stock will be next Amazon or Tesla or whatever. This doesn't work. If you want to see how you could find the best stocks, you have to have correct guidance. And luckily for you, this video will be perfect for that, because here I'll be showing you 5 key steps how to evaluate and find best stocks. So let's roll. First things first, before you invest, you have to understand company's business model, or as great Warren Buffett is saying, you have to have your own circle of competence and understand how business is making money. Because there are a wide range of stocks and companies which are doing completely different things. You simply cannot put in one bracket something which is, I don't know, purely industrial stock, which is doing something like heavy manufacturing, or at the other side you could have logistic companies, then you could have like high fashion houses such as Giorgio Armani, and then you might have software companies. All has different business models and different ways how to make money, or how they make money. So understand how each business model works before you work with them. And work with companies that you understand. If you're good with fashion, invest in companies that are in the appeal on fashion. If you understand retail, look at retail stocks. If you understand logistics, look at a logistics stock. Do not go outside your circle of competence. That's crucial. And then you'll be able to narrow down your list of companies, I would say by 90%, because we have to only find best stocks that work. We don't have to find them all, only that we understand. That's why first step is so crucial. You just separate something you understand from what you are not understanding. That's it. Easy to understand, but extremely important. Let's move further. Secondly, now you have to see and understand financial health of companies. And here you have to understand financial statements slightly better, because, well, at the end of the day, you will invest in company that makes money, and long-term company's stock performance will always reflect its ability to make money. So first and foremost, it has to be profitable with consistent growth rate, and also critically important, they have to have good cash flow positions. So in other words, business that cannot generate cash flow for long wouldn't be out there. So firstly, company has to have steady growth rates with healthy profit margins, or in other words, their share of profits out of total revenue has to be healthy and improving. You have to understand that. Secondly, they have to have good ways how they actually generate cash, because they might have good positions on paper, but if they don't have any cash from their operation, that's not sustainable for long term. And thirdly, I would say it's important how the company finances itself, or in other words, whether its debt levels are sufficient. Now, I cannot say precise criteria, because each industry has different aspects that you have to see and take into consideration, but I will just say, in total, debt has to be manageable in comparison with their assets, and long-term and short-term debt have to also be managed between total long-term assets and short-term inventories. And you have to see those ratios, in which direction they are working. If they are healthy, stable, and debt levels are constantly getting smaller and smaller, or this is bad position where company has to borrow money just to finance its cash flow. So extremely important to understand it. But here I am saying you there are 3 things: growth rate of company and how healthy its profit margins are. Secondly, how they generate cash and how stable is their ability to make good money, good cash from their basic operations. And thirdly, how they are managing their debts and how they are financing their operation. Is it sustainable? Is it improving, or it's not? Critical to understand these factors. But let's move on to point number 3. Now we have to understand company and its competitors. As I was saying in the point number 1, you have to have your own circle of competence and your industry. And now you have to see slightly deeper within that industry itself, because it might tell you a lot about company itself if you simply know the niche where it is working. I know it somehow goes hand in hand, because company's business model, which was point number 1, it's related to point number 3, where you have to understand its competitors and its niche. But here, bear in mind, you have to see whether your company is best in your industry or it's somewhere between. Because, well, there might be different patterns within each industry. There are companies which are constantly improving their shares, and there could be patterns where companies have been losing their shares. There might be hot industries and there might be boring industries. For instance, if you are seeing wild new industry, for instance, artificial intelligence, competition would be absolutely devastating, and companies that doesn't have huge amounts of capital beneath them, they will have extreme difficulty to compete against someone like Nvidia. And in that case, might be the largest companies are the most safest bets here, because, well, you simply understand that the level of magnitude they operate and that the fact that they are like leaders, and you have to simply stick with them. That's not the fact, that's like suggestion how you could look at it. But for instance, there might be declining industries, I don't know, such as tobaccos or waste management and whatnot, which are boring and forgotten by anyone for like past 30 years. But there might be really strong players which are gradually improving their shares by simply buying out competitors, and you simply don't know about them because you haven't looked at them, haven't worked with them. So there might be undervalued interesting things in really boring companies, and if you understand that industry, you might see really interesting patterns which is outside of established headlines. So if you understand industry, you could see how companies are performing within that industry, whether they are increasing or decreasing their shares, and it might say a lot about company and its future. So understand industry as well. But let's move on, let's go to point number 4. And actually, if you want to see more information in that manner, be sure you are following my Telegram channel, because there you could see much more comprehensive analysis of moving averages, other trading indicators, and various types of trading strategies in different markets. You will see with short-term trades, long-term trades, various types of combinations between indicators and risk management tools, and how you could stack it all together with your trading strategy. And of course, you could join it for free, and you can use my link below this video to join it. So take your time, explore this video thoroughly, and join my Telegram channel. Okay, point number 4. Let's understand key metrics of companies. This is somewhat related to point number 2, where we have to understand company's financial position. But here, ratios are somewhat helping us, because they are simply putting all those financial ratios in a couple of metrics. And let's explore these metrics a bit further. I would go with 3 key metrics if you are a complete beginner. First is price to earnings ratio, second is price to book ratio, and third is price to earnings growth ratio. First ratio is quite simple. It's price to earnings ratio, where we simply divide company's price by its earnings. The thing is sort of that the lower the price to earnings ratio, the company is more undervalued. The higher it is, it's more overvalued. But it's not clear mathematics, because there are different industries, and if you are going to see fast growth industry, price to earnings ratios will be really high. But if the price to earnings ratios are low for the industry, probably that industry might be quite conservative and boring. So if you look at price earnings ratios, look at them as a pattern and how they look at their direct competitors and with that company's history itself. Same goes with price to book ratio. You simply divide company's price by its total assets, and simply you see whether the price is higher than its nominal asset value or lower. Well, it might seem to think that if it's slightly higher than its overall assets, it might be overvalued, because how company's share price might be higher than worth of its total assets. But remember, company's value is generated by its ability to make money in the future, not by its ability to sell assets. So it might be perfectly logical that price is several times higher than its book value per share or its total assets. So here also look at the patterns, how the price to book ratio has been grown within specific company or within industry. Only then you can have some valid conclusion. And the third is price to earnings growth ratio. Price to earnings growth ratio is somehow similar to price to earnings ratio, but here we also take into consideration growth of company's earnings. So it has slightly different formula, but idea is the same. It simply shows price relative to its earnings growth rate. So the better the ratio, the more company is undervalued comparing to its earning growth. So it might be somehow more useful indication than simply price to earnings, because in 1 year earnings might be distorted, but this valuation tool makes the pattern of growth into consideration. But here also, as with previous 2 statements, have to see what are the pattern within each company and what are nature of competitors. So short conclusion about these 3 ratios. Look at them firstly at the whole industry. Secondly, look at the pattern of company itself, and then you see, for instance, if they are holding at the same level for a couple of years, but then they have suddenly fallen without the fact that financial metrics of company or its overall fundamentals are solid, you might have possibility to buy cheaper. But then also it doesn't happen that often, and you have to be quite skeptical if something suddenly really good shines up, because largest companies are watched by many people and there are a lot of less surprises than you might think. But at some point, something interesting might happen. So you have to see them dynamically, and you have to see it within the context of everything else. So if everything else keeps improving and somehow price has been falling because simply overall markets are depressed, then these valuations might look way better and you might have buying opportunity. This is the way how to look at them. But now let's go to the point number 5. Point number 5 goes slightly similar as I told you before, but here I will say you not only look at price to earnings or price to earnings growth or price to book metric, look at overall pattern of company, because you have to see stock as a company and how it actually has developed, where the company stood 10, 20, 30 years ago. And by that you might use something which might be relevant for future. For instance, does the company have strong products right now, and did it had strong products 10 or 20 years in the past? If for instance they have really strong brands such as Coca-Cola, you could see that their brands had been making name 30 years ago, and chances are it will do the same in the next 30 years. Question is how efficiently they work and how they are managing their operation. So see company's business model and its growth rate. Last 10 or 20 years might indicate something how it actually has developed, and if that development has made sense for you, there might be reasonable justification to see that next 5 to 10 years might be something similar. So, but always look in context of everything. Look context of industry, context of overall economy, and how company interacts with one and each other, because it has to be really good to take everything in the vacuum without seeing much of the competitors, and only a few professionals could do that. For you, I will suggest as what I just showed you before. See how company actually has worked throughout history, see whether it has some edges, see if it's improving or like decreasing against its competitors. You have to buy companies which are stronger than your competitors and improving their market shares, and see if they are doing that with translation to financial metrics, namely not only that it does look better than its competitors, but it also is improving its growth rate, it has good healthy profit margins, it has reasonable amounts of debt which they can manage, and they produce a lot of money by a direct cash flow. And then if they have good metrics such as price to earnings, price to book, and price to earnings growth, you might have a good company. Then you might start to buy it, but wait, maybe there are good moments when simply market crashes and it doesn't have any relevance to your company, you might have a bargain there. So this is very simplified way how to stack these points together and how they look. Of course, it's slightly more difficult that I'm saying but here's the pattern. Trick here is to follow it and not do nonsense. Simply without things that you understand and you don't understand the business, understand competitors, understand how they make money, understand financial statements and financial metrics. And if company is improving and it is healthy, you could buy. But you don't have to do a lot of times this. Only a couple of purchases could make or break your investment career. And if you want to see live analysis of markets and market patterns and how to actually look at markets as a professional, make sure you are joining my Telegram channel. It's free and it will provide you a lot of useful content here that could improve your investment decisions. So let's meet at my next video or at my Telegram channel. Stay tuned.